Hey guys, how's it going? It's Andy from Magoo Investing. In my last video, I talked about the different types of accounts that you can set up and the pros and cons to each one of them. And I think the next logical step is we talked about what type of accounts, and now we're going to talk about how you can be opening those accounts and the platforms that you can do it on. So I made a video on my main channel talking about my thoughts on Acorns back in 2019, and I did get a little bit of flack from it, and I'm here to clear my name. I'm not actually. I have no regrets for what I said there, and I stand by it fully, even though it pissed off some people apparently. But I wanted to set the record straight, and it has been 2 years, so I do want to give my updated opinions, talk about how I've been using the platform for the past 2 years and my future plans. So this video will be broken up into 3 parts. The first will be an overview of all the features that Acorns offers. Part 2 will be my own personal experience with Acorns over the past 3 years and talk about how I felt with it overall. And then finally, I'll talk about who I think would benefit from using this type of app and kind of the goals for what you're going to be aiming for using Acorns compared to a normal broker like a Robinhood or a traditional broker like a TD Ameritrade or a Charles Schwab. So Acorns has been around for a while. It's actually been around longer than something like a Robinhood. It was founded in 2012, and they've been continually adding features ever since I've been around the platform back in, I think it was like 2017, maybe 2018. The whole idea of the app is that with Acorns, sometime you can grow it into something amazing. And it's the idea that slow and steady wins the race for investing in the stock market, and you're not trying to time the market. It's keeping money in the market overall, and over the long term, you can turn an acorn into a giant oak tree. And that's kind of the whole premise of it. It's a mix of a robo-advisor and a savings app at the same time, and there are benefits to both of them, and I think putting them together is a very logical way to run an app, and it's probably my favorite part of it. Let's talk about the savings part, because I think this is probably the best feature that they have, and at this point, it's the only reason why I'm using Acorns at this point. So the app links to your bank account and rounds up purchases if you allow it to do so. What this means, if I go to the grocery store and I spend $4.50 on something, it's going to take that 50 cents, round it up to $5. It's going to take that 50 cents and it's going to stow it away until you hit the minimum of $5. And once your roundups reach $5, it will be invested into your account and it'll show up on your transaction history for your bank as an Acorns deposit. So this is a way to put in extra money into your account. I think recurring payments are great because it allows you to be consistent with your investments, but I love the idea of, in my mind, it's kind of like it's punishing me for spending money. So anytime I spend money, it's investing on my behalf, and it's kind of a good way to balance out my transactions. And so I personally do 2 times. So if I do $4.50, you round it up to the next dollar, which would be 50 cents times 2, it's going to be investing $1. It really depends on what you're looking for, but I think 2 times is a good place to start. So they do allow for recurring payments. It can be every day, every week, or month, but these recurring payments make sure that you slowly add to your account. And that's kind of the whole premise of this type of app. It's lump sum investing is great, but frequently adding to your account is a way that you reliably build wealth over time. And so that's what they're trying to instill in you as this very introductory type of app. And I love that. So what is a robo-advisor? Basically, you pick between 5 predetermined portfolios based off of what type of risk you're looking for. These portfolios vary between conservative to aggressive. And while aggressive, for most people, especially if you've been paying attention to some of the Reddit investors, it might be a little scary. But if you look at the aggressive portfolio, which is the one that I personally use, it's not aggressive at all. I would consider this as relatively conservative. You can see the breakdown of everything that you invest in. There aren't any curtains that kind of cover what you're investing in. 55% of the aggressive portfolio goes in the ETF VOO, which follows the S&P 500 and is made up of the 500 largest companies on the New York Stock Exchange. So while it is aggressive by name, it is not aggressive if you compare it to a lot of the ways that people invest. And based off of the way that I invest and talk about it on my main channel, my investing strategy would be like super, super aggressive. But if you see what people are doing on Reddit, that's like the extreme version. So it may seem aggressive, but you can kind of determine which one is best for you. I would highly recommend staying away from conservative because it is pretty much a waste of your time. Just to talk about it, you can see how all of these individual ETFs have performed over the past couple years. You can just Google VOO ETF, as I mentioned before. It follows the S&P 500, which on average has returned around 10% a year for the past 100 years. And so let's look at the difference in returns between the aggressive and conservative portfolio, because I feel like a lot of people that get started, the emotional toll of losing money in the stock market may push people to picking the conservative option, but I want to show the difference between investing in the quote-unquote aggressive compared to the conservative portfolio over an entire lifetime of investing. So using the numbers that I always use on this channel, $1,000 of initial investment, $100 a month for 40 years, with a return of 10% based off of the S&P 500, you would have $576,000 to retire with. With a conservative portfolio, 20% goes into the ultra short-term government bonds, which is the stock ticker BIL. This gives an annual return of 0.64%. 0.64%. For a lot of people, you could find a savings account if interest rates weren't zero that has better returns than that and has the same amount of risk, which is 0. And so having returns like that, same amount of money, it has only been around since 2007, but with dividends, it has returned a total of 9.1% since 2007. That's brutal. Compared to 237% with the S&P 500. Using those same numbers, you will retire with $55,800, and you invested $49,000 of it. So yes, it does seem beneficial to be safe with your money overall, but when you're talking about the long run of investing in the stock market, the aggressive, you really need to determine what aggressive means. And being aggressive and investing in the overall stock market for most people would be considered conservative. And I think staying with the conservative portfolio is an absolute waste of your time, and there's much better places that your money could be sitting. So now let's talk about some of the other features. There's the Found Money feature, which is a partnership with a bunch of brands that allows you to get money back for money spent through the app. And so this is not something that I used a lot. I think I've brought in like $50 total. If I know I'm going to be buying something online, I will go through there and just kind of see if I can get some money back. It's not a lot, but the whole point of this is you're trying to kind of pick up additional quarters over time, which over the long run will build wealth. And so that's kind of the whole idea behind it. I would never go, oh, I can get 5% off with Nike, I'm going to go buy something. But if I was already going to be buying something through Nike, if I can find a cash back thing, I will happily do that because it's basically free money. They also have Acorns Later, which is a retirement account, which is somewhat of a recent feature. And then they have Acorns Early, which is used for a children's investment account. They have 3 different account types you can open with different prices. When I first got started, you were able to create a free account if you had a student email. This is an email that ended with a .edu, but from what I've seen online, I guess I got rid of it. And that was a very beneficial thing. I'll talk about why in a little bit. So the bottom account is the Lite account. It gives you all the important features that I would care about for $1 a month. $3 a month gives you access to the retirement account, a checking account, and a debit card. And for $5 a month, you get everything mentioned in the $3 account and the addition of having the Acorns Early, which is for the children's account. So let's get to part 2, talking about my experience with Acorns, because I've been using it for a while at this point. Acorns was the first investment app that I ever opened because I liked the idea of being conservative with my money, and being able to invest just a couple dollars at a time was very attractive to me at the beginning because, believe it or not, I did have some very strong emotional responses to losing money in the stock market. And I thought investing slow was a very great way to start. And then I went down a bad YouTube rabbit hole and I ended up day trading, and then I lost 75% of my account. But I kept my Acorns account open the entire time, and I did make money during that time. So Acorns has been around for me for a long time. And at this point, I don't have it as an app on my phone, but I do occasionally check on it online, which is a great option. The whole idea is that this is a set it and forget it type of mindset. Here's what my account looks like right now, and it's very interesting because at the beginning of the pandemic, I cashed out my account because I wanted to keep a lot of cash on the side because I was going to put it into more aggressive investments where I bought at the beginning of April at the bottom of the stock market, and I made a lot of money from that. But you can see that the account went to 0, and then I've slowly been investing in it over time, and I kind of forget about it. And that's the whole idea, is that if I invested this all at one time, I would definitely notice. But over the course of a couple months and rounding up my purchases, it allows you to save up additional cash that most likely you wouldn't have been saving up at this point. So that's the whole benefit of it right now. So I haven't opened the Acorns app until I started making this video for months. And I'm back up to $200, and that money is continuing to grow, and is growing at a rate that's faster than the rate that I would be getting in a bank at this point because interest rates are 0. So in college, this was a no-brainer to use for free because there was no downside, and you get the upside of the robo-advisor. You get the benefit of the rounding up your purchases, and you get the found money. And so there was no downside to using this while I was in college. But now I want to talk about who would benefit from using this type of app. And $1 a month does not seem like a lot, but when you look around at all of the other investment apps, besides something like a Stash, which I'll probably talk about in a future video, pretty much all investing apps are free. And so $1 a month doesn't seem like a lot, but when you consider the other investing platforms that are free, it sucks. Also, if you're starting fresh in the overall stock market, $1 a month does not seem like a lot, but if you're starting with $100, you're going to be losing 1% of your portfolio every month. And that is likely going to be outpacing the returns that you're going to find with the stock market because, as I mentioned, it returns 10% a year on average. And so some years it'll be up, some years it'll be down. And so that's taking a big hit from you overall. So in my opinion, the way to maximize the potential of something like an Acorns, I would not consider investing into Acorns until you hit the $200 threshold, because this is the point where you have some money set aside to invest. And the $1 a month, while it's not great, and obviously free would be better, it's not going to be taking out a percentage of your account that's not going to be possible to be beat by the overall stock market, because it wouldn't make sense investing in the stock market if you were not going to be beating it and you're going to be losing more money a month based off of the payments that you're making. So $200 is where I would consider it, but obviously the more money you can put in at the start, the less important the $1 a month is going to be. And now let's get to the point that pissed off a lot of people in that video that I made on my main channel, and that is In my mind, there is no reason to be paying for the $3 or the $5 a month account. So the $3 account gives you access to a retirement account, which, it seems great. Retirement, that's what we talked about in this last video, right? But it's $3 a month, so $36 a year, when pretty much every other broker you can open a retirement account in like 5 minutes for free. And while it does allow you to open a Roth account, which I talked about in the past video, is one of the most beneficial ways to grow wealth, because the money that you're making off of your initial investment that has already been taxed, that growth is not being taxed at all. And so we love that. You are able to make a Roth account with Acorns later, but the whole idea of me disliking using Acorns for a retirement account is you're investing for retirement. For my situation, I am 24 years old. I'm at least 40 years away from retiring. And at this point, when you look at the history of a company like Acorns, it's only been around for 8 to 9 years. Is there a 100% chance that it's going to be around in 40 years when you go to retire? No. It's much more likely that a major broker like TD Ameritrade will be around or will have been bought out by something else. Another reason why I dislike using Acorns later is the fact that it's very expensive to transfer positions out of Acorns. The whole idea of using a retirement account in the first place is to maximize your gains without paying fees or taxes. And it's a lot easier if you're in a normal retirement account, because let's say I'm in TD Ameritrade, I want to go to Schwab. I can just fill out a form and my positions will be sent from TD Ameritrade to Schwab. It won't be sold, so I won't have to be paying any taxes or pay any fees. I would just be moved over. You are not able to move ETFs for free based off of Acorns. And there is actually a very expensive payment. It's $50 per ETF to move, and for the aggressive portfolio, which I would recommend, that'd be $250 just to move it to a different broker that is likely going to be around longer than something like an Acorns. $3 a month does not sound like a lot, but over 40 years, $36 a year, at 10% means that you miss out on $16,000 by the time you retire. And so it kind of goes against the whole premise of using Acorns as an investment tool, because Acorns is designed to pick up the scraps that you maybe would forget about. That's the whole idea of the rounding up feature. And so $3 a month does not sound like a lot, but it does build up over time. And you could make a lot more money by just investing that money instead of paying for a feature that you could do for free elsewhere. Also, with the Acorns Early, you can just create a 529 if you really wanted to for free on a major broker. And that type of money for $5 a month would turn into $26,500. Investing for retirement is good. Acorns later, I don't think is the best way to do that. So overall, I think Acorns is a fantastic way to get started in the overall stock market. It allows you to get a basic understanding of how the stock market works, understand that the stock market moves up and it also moves down. And so you understand the emotional toll that has. In general, I would say the best amount of time to be using Acorns is like 6 months to a year and a half. It gives you a good basis to understand how things work, but after a while, the $1 a month is not worth it. And if you want to recreate that same portfolio, it's very easy to do that. It's only a 5 ETF portfolio that you could do based off of fractional shares. And so I would never consider using the Acorns later or the Acorns early. I think it's a waste of money. You can do it for free on a major broker with a little bit of assistance if you really needed help like that. And so overall, Acorns is a fantastic way to get started. I would consider it like training wheels, but it is a fantastic way to learn about the overall stock market. And I will be closing my account after this because it has served the purpose that I needed it to, and I can put my money elsewhere. I'm very comfortable investing in the stock market, as you would expect. So thanks for watching this video. I appreciate all the support, and I will see you next time.